All right, let's get right into it. So you're a business owner, and you do the smart thing. You buy the building your business operates out of. Fantastic move. But you've probably run into this massive tax headache. Your business is making money, that's active income. But your real estate, it's probably showing a loss on paper, thanks to things like depreciation. And that's passive. And guess what? The tax code puts up this giant brick wall right between the two. In this explainer, we are going to talk about the sledgehammer designed to tear down that wall. It's called the grouping election. So this is the big question, right? You've got your business over here cranking out profits, and then you have the building it's in, which you own, and on paper it's losing money, mostly thanks to those huge depreciation write-offs. Can you smash those two together to lower your tax bill? The short answer is yes, you can. But, and this is a big but, it's not a free-for-all. You have to navigate this, let's call it a technical gauntlet, that the IRS lays out in the Treasury Regulations. Okay, so here's how we're going to break it all down. First, we'll look at the passive loss problem itself, then the solution, the grouping election. We'll get into the weeds with the AEU test and the 3 big exceptions you have to know about. Then we'll cover some traps and other tricky rules that interact with this. And finally, we'll look at the big payoff when you pull it all off. All right, let's kick things off with Section 1, the passive loss problem. To really get why the solution is so powerful, you first have to understand the problem it's designed to fix. And it all boils down to one specific, really important part of the tax code. Okay, time to get specific. We're talking about Internal Revenue Code Section 469C2. And it says point blank that any rental activity is a passive activity. This is what tax pros call a per se rule. That means it's automatic. It's a done deal. I mean, you could be spending 2,000 hours a year managing your building. It doesn't matter. The law just slaps a passive label on it by default. No questions asked. And this is the result. It's a perfect picture of the problem. Over here, you've got your active business income, all that profit you're working hard for, and it's all taxable. Then over there, you've got these rental losses, usually just paper losses from things like depreciation and interest. And Section 469 builds this impenetrable firewall right down the middle. So those awesome rental losses, they're completely trapped, stuck in what we call the passive bucket, and you can't use them to touch your business profits. So the big question is, how do you break through that firewall? That brings us to Section 2, the grouping election solution. And funnily enough, the key isn't in the Internal Revenue Code itself, it's tucked away in the Treasury Regulations, giving us a really powerful option. Here it is. This is the magic key, Treasury Regulation Section 1.469-4. You're going to want to remember that one. This is the specific rule that lets you make the grouping election. And what does that mean? Well, it basically lets you go to the IRS and say, hey, I know these are 2 separate LLCs on paper, my business and my building, but for tax purposes, I want you to treat them as one single thing. Now, the whole idea behind this rule is something called an appropriate economic unit, or AEU for short, and really, it's just common sense. The goal is to make your tax return reflect what's actually happening in the real world. I mean, if your manufacturing business and the factory it's in are basically one single enterprise, why shouldn't they be treated that way for taxes? The AEU concept says they can be. But of course, it's not quite that simple. You can't just say they're one unit, you have to prove it. And that brings us to Section 3, which is the first big hurdle you've got to clear, the AEU test. You have to make the case to the IRS that these activities really do belong together. So, if you look at the fine print, specifically Regulation 1.469-4C2, it's very clear this isn't some simple check-the-box test. The decision is based on, and this is a direct quote, all the relevant facts and circumstances. What that means is the IRS is going to look at the whole picture, the complete relationship between your business and the building. Now, even though it's a facts and circumstances test, the rules do give us 5 big factors that carry the most weight. And honestly, for most people in this situation where you own the business and the building, a few of these are total slam dunks. I mean, geographical location, they're in the same spot. Common control and common ownership, check and check. But the one that really matters here is interdependencies. You have to show that one of these things just can't work without the other. Okay, so let's imagine you've cleared that first hurdle. You've proven it's an appropriate economic unit. Great. But hold on, you're not out of the woods yet. In fact, we're now at what is arguably the most critical part of this whole thing. This is where most attempts to group either succeed or fail. This is the real gatekeeper. All right, here's the kicker. Regulation 1.469-4 D1 actually starts out by saying, no,
It lays down a general rule that says you may not group a rental activity with a trade or business. That's the starting point. It's forbidden unless. And that unless is everything. It opens the door, but only if you can squeeze through one of three very specific, very narrow exceptions.
And here they are, straight from the reg itself. Subsection D, D1I. You can group if A, the rental part is insubstantial compared to the business part, B, the business part is insubstantial compared to the rental. Now, insubstantial is a whole other can of worms, but let's focus on the big one. It's C. Each owner of the business has the exact same, down to the penny, proportionate ownership interest in the rental. For most small business owners, this is the golden ticket. This is the one you're aiming for.
So, let's say you did it. You met an exception, you're ready to group. Awesome. But we've got to talk about some other landmines in the tax code. This is Section 5, Navigating Traps and Interactions, because these rules don't exist in a vacuum. They can bump into other regulations in ways you might not expect.
First up, let's talk about the ugly trap you fall into if you fail to grow or just don't do it. It's called the self-rental rule, and you can find it in Regulation 1.469(2)(f)(6). And trust me, this rule is just brutal. It's a classic heads I win, tails you lose situation for the IRS. It says if you rent to yourself and make a profit, that income gets relabeled as non-passive. But if you have a loss, oh, that loss stays passive. It's literally the worst possible outcome in both scenarios. And hey, don't just take my word for how nasty this rule is. The U.S. Tax Court said it themselves. In a case called Carlos v. Commissioner, they spelled it out in plain English. This quote from the court just hammers home how punishing the self-rental rule is, and it really highlights why you absolutely need the grouping election to get around it. Okay, let's shift gears to something a bit more advanced. The grouping election we've been focused on, the one in Regulation 1.4694, sometimes has to fight with another set of rules. These are the rules for real estate professional status, or REPS, and they live in Regulation 1.4699. The tricky part is that these two rules can clash, and one can actually override the other. This chart here lays out the pecking order perfectly. Look, if you're not a real estate professional, it's simple. The regular grouping rules in 1.4694 apply. No problem. But the moment you become a real estate professional, everything changes. The REPS rules in 1.4699 take over, and they generally say, no, you can't group your rental with your business. There's one tiny exception. If you already had a valid grouping in place before you became a REPS. And then if you stop being a REPS, the power switches back to the old 1.4694 rules. It's a really complex dance between these two regulations that you have to get right. So, after jumping through all those hoops, after navigating that entire maze of regulations, what's the prize at the end? Why bother with all this? Well, the answer is simple. A whole lot of tax savings. Let's put some real numbers on this to see the impact. Let's say your business made a $500,000 profit. Awesome. At the same time, your building, maybe because you did a cost segregation study, is showing a paper loss of $150,000. Without grouping, that loss is useless against your business profit. But with a successful grouping election, boom, you get to wipe $150,000 right off your business profit. Your taxable income just dropped by that much, saving you something like $55,000 in taxes. That's real money right back in your bank account. Okay, one last thing, and this is absolutely critical. You can't just, decide to do this and not tell anyone. A grouping election is a formal, official statement you make to the IRS. You have to attach a specific disclosure to your tax return. Revenue Procedure 2010-13 tells you exactly what needs to be in that statement. If you mess this up, if you fail to file it correctly, the whole thing could be thrown out. And really, this quote brings it all home. When you think about it, the loss on your building isn't a failed investment. It's a cost of doing business. It's part of the price of running your company. And all the grouping election does is it lets the tax code finally catch up to that common sense economic reality. So let's wrap up with a final thought to chew on. Getting this grouping election done is step one. It's like unlocking a door. But the real next level strategy is asking yourself, now that the door is open, how can I make that loss even bigger, especially in years when my income is sky high? How do you combine this powerful election with other strategies, like cost segregation, to really supercharge your tax savings? Now that is thinking like a true tax strategist.